Hey everyone, welcome back to the Your Money Life podcast. We're in episode 322 of the podcast. Make sure wherever you listen, you like, subscribe, five-star rate and review this pod. Took a break last week, but we're back at it again. We have a bit to get into, so we'll have to get into it right now. The first and foremost, we always start with a market update. We tell you what has been going on over the past several days, primarily, and then we'll also pull the picture back and see what's been going on in a more general sense over the past several years. So let's jump into that now and show a little bit about what we're seeing. So if you jump into the market, first thing we're going to see here is our chart. And the past 5 days, we've actually had a resurgence of the market. The past 5 days, we'd have resurgence of the market because we were told, or the market believes, that the conflict in the Middle East is going to subside and the Strait of Hormuz will be open, is what the market's believing. Oil prices went down, market went up. And again, now if is that stable? Is that real? Is that going to stick? That's the big question. I still believe there'll be volatility for the next couple of months, month or so at least, but maybe not. The market is right now believing that things have subsided. The deal will get done in a couple of weeks, and that things will be at steady, and then they believe and know what's going on. So let's dig into like what CNBC is reporting this morning. Futures are slipping this morning a little bit, and on Tuesday night we saw that Trump agreed to pause attacks on Iran. The Middle Eastern conflict has been going on for 5 weeks and has resulted in the closure of the crucial Strait of Hormuz. The double-sided ceasefire, however, was contingent on Iran agreeing to reopening the strait. Tehran agreed to reopen the waterway for the next 2 weeks as long as the attacks are halted. And this is according to a statement from Iran's foreign minister. Media reports said that Israel has also agreed to ceasefire. But later on Wednesday, Iran's parliamentary speaker accused the U.S. of already violating the ceasefire agreement. The violations are Israel's continued attacks on Lebanon, a drone's entry into the Iranian airspace, and the denial of the Islamic Republic's right to enrich uranium. So again, this is still ongoing, and we haven't seen the end of it yet, and that's why we said it earlier on. This will be a few months thing at least, and we've already been 5 to 6 weeks already into it, maybe another several few weeks, if not more, which would hit our timeline, right? But again, right now the market's saying, okay, things are pat, and we had a huge resurgence yesterday, and in the market, where the market and S&P 500 was up 2.5% roughly, Nasdaq up almost 3%. And year to date, the S&P 500 is climbing back to flat. The Dow is about flat year to date, and so we've really had a resurgence over the past week. But now, again, if that volatility is gone, I don't believe so just yet. They haven't. The agreement is supposed to be a ceasefire for 2 weeks to get to an agreement, so the agreement hasn't been finalized. But as of right now, the market believes they know what's here and what's hitting us, and they've calmed down. As you can see, the resurgence on a year chart, you can see the bottom here, at least the bottom for now, and the resurgence that we've had in the market. So that's our picture right now. It's an interesting picture, and it's not fully done, but that's the market update. Again, I think volatility continues for at least another few weeks. So we'll see what happens as things unfold. Let's jump into news that we may have missed. So the Fed, remember, the Fed is still a part of this whole equation. The Fed is saying during their March meeting that they released the minutes. They warned that inflation spikes resulting from energy supply disruptions amid the Iran war may lead to higher interest rates. Minutes was released on Wednesday, and they said that a vast majority of policymakers displayed an openness to future rate increases to tame inflation and quell recession fears. Even with the recent ceasefire between the US and Iran, the conflict may preclude any rate cuts in the near term. Still, the consensus projected at least one cut this year, unchanged from the December forecast. So they're saying, hey, because of this new item that was thrown into the mix of our economic activity, we may have to potentially raise interest rates. We're not sure. We're going to see energy supply disruptions, which may have increased the price of energy, which may increase inflation, which may cause us to have to raise interest rates. So we're just going to keep that pat. But they did say, if they still have the consensus that they will have at least one more rate cut this year, we're only 4 months into the year, and they say, hey, we still may cut rates once more, but because of what's going on, we're not even sure that inflation is going to be fully tamed because we're seeing the price of Brent crude oil go up. We're seeing the average price of gasoline at the pump increase to over $4. national average. So they're like, whoa, we have to watch this a little bit more before we say anything. So Fed officials a little bit worried about that. And that's still going to be, again, because of the volatility of this 2 week pause is still ongoing. And so they're not sure what they're going to do at the next meeting. I think Jerome Powell's term is up in April, if I'm not mistaken. So he's not, doesn't have much more to go. So who is going to be the next Fed chair is going to be an interesting watch because they're going to have a lot of sway on what happens going forward for the rest of this year as far as interest rates. So that's going to be huge. But the conflict is affecting a lot of things, and that uncertainty is affecting things. But the market right now is okay with it. It's okay with it. Let's move to Disney news. Disney's preparing for more layoffs in the coming weeks. Disney is gearing up to lay off as many as 1,000 employees over the next week. This is from the Wall Street Journal. The reduction mainly from its marketing department is one of the big changes under the new CEO, Josh D'Amaro, and come as Disney faces an array of challenges, including smaller box office halls and stiff competition. I don't know if you guys saw, I think it was Intel. Was it Intel layoffs or who was the layoffs? Intel layoffs. Was it Intel? Um, It was another company that did some layoffs recently, and I think it was Intel. I'm not sure. But yeah, you're seeing this across the way that people are making these adjustments now. Some of them are adjustments for overhiring during the big tech boom of hiring. Some of them are adjustments for um, layoffs. Related to like efficiency, AI, and different things. Some of them are just like, hey, we overhired and we're trying to increase profits. And so a lot of companies are doing those depending on what's their situation, right? It's case by case. And really, really just depending on what's going on. But that's something to watch out for. And that's plays into the earnings and plays into what happens in the market going forward. But Amazon, on the other hand, is telling investors and shareholders to bet big on AI. So artificial intelligence isn't a bubble. That's not what Andy Jassy, who's the CEO of Amazon, believes. He did his annual share letter to shareholders, and he released that this morning. And he touts the explosive growth of Amazon's cloud computing division, AWS, and he predicts that the company's chips will change the economics for AWS and will be much larger than most people think. He also takes aim at the pervasive worry for tech investors, massive capital ventures. So if you know a lot of the reasons why people aren't saying that AI is like taking your job because it's going to be like they don't need you anymore. Some of that is there, but not as much. But they're saying because companies are investing so much in AI, that capital expenditure, that money, it's billions of dollars that can't be used to pay people. They have to cut jobs so they can invest in AI, and that makes more sense to me economically, as a sense of it's not just like something taking over your job. It's more that because they have to invest so much in AI and the growth of AI, chips, infrastructure, all those different things, they have to cut costs somewhere else. And that's primarily going to be headcount. And once they invest in the AI, they're expecting it to become a situation where they're a much more efficient company where they would not have needed that headcount anyways. So I do see a lot of people. There was a CNBC report that people are proactively leaving their job because they're worried about what I just explained, that AI is and the investment AI is going to take their job anyway. So they might as well start their own venture, which, I agree with. I'm always in stage of entrepreneurs as someone that's done well as an entrepreneur. Um, you, the earlier you start, the better, right? Like if you're going to be successful, you're going to make it, it only behooves you to start earlier, right? Because it's going to be just better for you overall. So the earlier, the better. I always am a proponent of that, but that's what's happening. You're going to see people investing in AI, and because of that investment, these companies have to cut headcount. So just be aware of that. Make sure you're aware. Again, it's not saying that like some AI is just going to take over your job. These models per se, it's more that they have to make an investment in the infrastructure. So speaking of AI, Meta unveiled a new closed source AI model dubbed MuseSpark. Why do they always have weird names? What is that? MuseSpark. Meta has debuted a new AI model as the Instagram owner is trying to catch up to OpenAI, Google, and Anthropic. So Meta, yeah, that's one thing that's interesting to me. Meta isn't really that doing that well with AI, at least from the consumer standpoint. They don't have some sort of product or chat box that people heavily use in my mind, right? They have one, but I don't know how much it's being used. But they now are trying to do another model. It will be used to power the TechSide's chatbot and embedded AI features. They said in a release Wednesday, and it's a milestone for the company after its Llama 4 model, which launched last year. It failed to impress, leading Meta to hire AI superstar Alexander Wang. And this is from him, Alexander Wang, from his LinkedIn. Today, we're releasing MuseSpark, the first model from MSL. 9 months ago, we rebuilt our AI stack from scratch, new infrastructure, new architecture, new data, pipelines. MuseSpark is the result of that work and now powers Meta AI. MuseSpark is natively multimodal reasoning model with the support for tool use, visual chain of thought, and multi-agent orchestration. It's the most powerful model that Meta has released. Okay, and I think they paid this guy like $1 billion to just come over to Meta and to create this. And so that's quite interesting. And we'll see if this is actually interesting. You're seeing that Claude, which is owner Anthropic, you're seeing Google, which is Gemini, you're seeing Chat GPT, which is Microsoft and OpenAI. Those models have been doing well. They have mass consumer adoption. Haven't seen the same with Grok, which is Elon Musk and Twitter, X, or Meta. And so we'll see. This is going to be a battle that's ongoing. These people are at a race. There'll be more than one winner. There'll be multiple winners, but I think one of them will have the lion's share of the winnings, the most used. Widely think about it, like Google is like the big market share in search, right? Like Yahoo used to be even more widely used before Google came in and just swallowed up the market share. So one of these is going to be the big winner, but I think there'll be multiple used in the future. I think everyone, when I use multiple, some are better than others at different things. So that's something to watch. Again, this conversation is been getting more and more rampant. So you have to keep your eyes on it. In the meantime, let's go into the roundtable and let's talk a little bit about contributions to your IRA. So people are confused a little bit on contributing, I should say, to their IRA and what constitutes what you can do, how much you can contribute. So, as we know, for 2025, you think about the base IRAs, there's multiple, right? But if you think about the base ones, we're talking your traditional and your Roth, the traditional being pre tax, your Roth being the after tax. So now everyone's like, okay, what can you actually contribute to set accounts? Now for 2025, and you still have a few days to contribute, you know that you have 7,000 combined. So you can't contribute 7,000 to a traditional and then another 7,000 to a Roth. That 7,000 is a combined limit. It's a combined limit. Um, to your IRAs, those two IRAs, right? The traditional and the Roth. Now, if you think about that, right? Now for 2026, that combined limit is now 7,500. So again, you can't do 7,500 into the traditional and then do a 70 another 7,500 to Roth. That's a combined limit. So you could split it, but you can't double it. So that's one thing to note is understanding that the limits, if you already put some money into traditional, if you want to add to your Roth, you still can, but the limit for both of them, the combined limit is 7,500 for 2026. And so that's something to note. So it's about across both accounts. So you can only do that. Now let's think about the SEP IRA. It has a separate limit. If you have a SEP IRA, if you're self-employed, that's another IRA that's for self-employed people where they can contribute, that can lower the taxable liability, it can grow and invest for the future. It has a different limit. You contribute 7,500 into your IRAs total, right, across both of them. But you can also do SEP contributions on top of that, and there's no mix or there's no issue with contributing to your SEP as well as having maxed out your IRA 7,500 contribution limit to either IRA or both, right? And so the SEP is on its own. You just have to have self-employment income, and it's based on the contribution is based on the net business income that you have, not gross. So net business meaning after expenses taken out what your net earnings are. Typically, that's the amount. And so the SEP we know has a higher contribution limit than the um, traditional in the Roth. Typically, you see people want to contribute more, maybe 10, 15, 20, 30K to their SEP IRA if they want. And again, that potentially does lower taxable liability by how much your CPA will know. So those are things to keep in mind is there are different limits across different IRAs. You do not have a multiple 7,500 for both IRA and traditional. It's a combined limit. And so those are things to know about that. And you want to keep that in mind as you're trying to finish your contributions for 2025 and potentially starting for 2026. So keep that in mind. Let's do one question this week because I saw one that was interesting. Since we're talking about taxes, how many Americans receive a tax refund and what is the average amount? I would say the average amount was like $3,000, and I think what there's 300 million of us, so maybe 100 million people receive it. But most people are business. A lot of people are business owners. I'd say not most, a lot of people. So I'll cut that to 70 million, and I will say $3,000. Seven out of 10 Americans. So I was way off. How many is 7 out of 10 Americans? What is that? 70% of the 300 million that we have? Are we at 350 or 300? So that's three, probably say about 300 million people. And then it's the average amount is 3,571 so far in the 2026 year. So again, that's for people that have a W-2 and have their money withheld versus business owners that pay, like myself and many others. Interestingly enough, that's an interesting question. I thought that was good. Folks, remember, we do this every week, so make sure you like, subscribe, 5-star rate, and review this podcast as we do this every week, and we will talk to you next week.